Hello friends, welcome back. As discussed earlier, a financial statement consists of three components, namely income statement, balance sheet and cash flow. Now I'm going to explain in detail what these are and how we can use them for analysis. Let us start with the balance sheet. What is a balance sheet? A balance sheet is the financial position of the company, the business or the individual as on a particular date. Basically, a financial position indicates what are the assets that we own, what are the liabilities we have, what are the loans you have taken, and what is the cash we hold. Basically, it tells you about the financial position of the company and how strong are we in terms of our assets and liabilities. It is a snapshot of the company's assets and liabilities. Another point that we need to understand is that a financial statement coverage timelines. Let us take the income statement for a particular year from the 1st of January to the 31st of December. However, the balance sheet is on the last day of the financial statement. If the year end is on the 31st of December, we make the balance sheet on the last day, which we have on the 31st of December to show the world what kind of assets we own and the liabilities we have. The most important concept in the balance sheet is that the total assets should be equal to the liabilities versus the shareholders' equity. Assets are things that we own, and liabilities are the dues that we should pay. The equity is the amount that the shareholders have invested in the business. Basically, this equation must hold good and the result should match in the balance sheet. Please note that for each year, the balance sheet should match, which means that the assets should equal to the liabilities versus the shareholders' equity. If this is not matching, it means there are some problems or mistakes in the balance sheet. In other words, the assets are financed by the liability, which can be obtained by borrowing or the owner's equity. There are various structures of the balance sheets. Different people use different structures, but one of the most common structures of the balance sheet is what we have mentioned. As said earlier, there are different formats of a balance sheet. We can use any format of the balance sheet as per our requirement. However, it should be according to the accounting standards of our country. In a general format of the balance sheet, all the assets are written in the first place, followed by the liabilities and then the equity. Another way of writing is that we write the assets or the items of the balance sheet in terms of liquidity. The liquid assets are written first, followed by the illiquid assets. For example, if we are writing the assets in the balance sheet based on the liquidity, we first write cash. Then we write inventories, followed by the intangibles and fixed assets. I am writing in terms of liquidity of the company to see how quickly I can liquidate these assets and recover the money. Let me talk about the equation, which is very simple. The assets should be equal to the liabilities plus the shareholders' equity. What is shareholders' equity? Shareholders' equity is the amount of money which is listed by the equity shareholders plus the reserve in surplus if it has. Let us understand each of these. What are assets? Assets are the resources owned and controlled by the company, such as plant and machinery. Fixed assets, current assets and intangibles, using which company generates high cash flows. Liabilities are the obligations of the company, which are to be paid. For example, the company had taken a certain amount of debt and repaid it. This is an obligation. The tax which the company has not paid, and which should be paid in the near future, is the obligation of the company to pay the tax. If the company has not paid any liability, pension liability obligation, or salaries, then it should pay these in the near future. It should pay all the obligations which have been put as the liability. An obligation can be in the form of debt, current liability, or shareholders' equity. The shareholders' equity is very simple. It is basically the difference between the assets and the liabilities. What is shareholders' equity? Shareholders' equity is the equity capital, reserves and the balance of the profit such as retained earnings, which we have transferred to the equity investors. Basically, any amount of returned earnings, or any amount of profit which is retained in the business, belongs to the equity shareholders. All these things belong to the equity. This is called the shareholders' capital, or the net worth of the company. This is what the balance sheet is all about. Again, let me repeat, the asset should be equal to the liability per shareholders' equity. If it is not matching, then there is some problem in the balance sheet, which we need to find and understand. I hope you've understood the concepts, friends, and in case you have any questions, queries or doubts, feel free to send us an email or connect with us. Thank you, friends, and have a nice day.